Welcome to Echoes of Africa, where hidden stories, bold voices, and untold truths rise from the heart of the continent. Before you dive in, hit subscribe and turn on the bell, because every echo here reveals the Africa they don't want you to see.
South African President Cyril Ramaphosa says his country is in talks with a U.S. trade representative to reduce tariffs after telling world leaders that trade is being used as a weapon. President Trump last month imposed a 30% tariff on imports from the country. The South African leader also said a trade arrangement with the U.S. that has been in place for the past 25 years should continue. It was scheduled to end this month.
A coordinated freeze on U.S. investment by 10 African nations creates one of the most dramatic geopolitical shocks in modern economic history. The scenario begins with a synchronized announcement issued through official government channels across multiple African capitals. The messages are concise and uniform. New American investment approvals are temporarily suspended, pending a comprehensive review of existing terms and a renegotiation of future economic engagement. No advance notice is provided. No preliminary negotiations leak to the press, and no private consultations occur with American diplomats or corporations. The abruptness of the decision marks the first indication that the continent has entered a new phase of geopolitical assertion. Within minutes, global financial systems react. The world has relied on long-term projections of African economic growth to shape global investment forecasts. A freeze instantly disrupts expectations anchored in decades of corporate planning. Africa is more than a collection of markets. It is a strategic hub holding critical mineral deposits, rapidly expanding digital corridors, vital maritime choke points, huge agricultural capacity, and the youngest workforce on Earth. These realities amplify the shock of coordinated policy action. Investors understand that the freeze does not remove current American-owned assets, but it invalidates forecasts built on future access, expansion, and partnership. In the global economy, predictions shape prices as much as real assets do. When predictions change, valuations collapse. The immediate concern centers on critical minerals. Africa's mineral belt supplies a significant share of the world's cobalt, lithium, manganese, chromium, platinum, and rare earth elements. These resources serve as the backbone of electric vehicle manufacturing, battery storage technology, aerospace engineering, renewable energy infrastructure, and specialized electronics. The freeze revives fears of restricted access and renewed geopolitical competition for mineral supply. American companies that rely on long-term contracts, joint ventures, and anticipated concessions face sudden uncertainty. As traders calculate new risk levels, futures markets spike across multiple commodities. These price adjustments ripple outward, increasing projected production costs in the tech, automotive, and aerospace sectors. Corporate exposure becomes the next focal point. Several American multinational corporations depend heavily on African markets for expansion. Energy companies rely on oil fields in Nigeria and Angola. Telecom giants plan cloud and digital infrastructure across East and West Africa. Consumer goods corporations forecast population-driven demand for decades to come. Agricultural firms depend on African partnerships for land use rights, export processing, and distribution networks. The freeze forces all of these entities to reassess their long-term strategies. Each adjustment triggers revisions in stock valuations, contributing to market volatility. Technology firms experience distinct pressure. Africa represents the fastest-growing digital consumer base in the world. A freeze halts planned investments in data centers, cloud infrastructure, undersea cable expansion, and mobile payment ecosystems. These delays reposition competing global powers, such as China and India, to capture digital market share. Investors recalculate projected earnings over the next 10 years, reducing growth premiums previously priced into American tech stocks. Small changes in projected long-term growth generate massive declines in market capitalization for technology companies with global portfolios. These declines fuel further sell-offs, magnifying overall market loss. In the energy sector, the freeze raises questions about future contract renegotiations. American oil and gas companies operating in Africa often depend on multi-decade agreements that influence global energy stability. A coordinated freeze implies the possibility of revisited royalty structures, increased local content requirements, or greater government participation in joint ventures. Even without immediate policy changes, the risk of renegotiation lowers the certainty of future profits. This drives declines in share prices for major American energy corporations. Renewable energy companies also face setbacks. Africa's vast solar, wind, geothermal, and hydro potential plays a key role in global sustainability planning. The freeze stalls ongoing renewable projects and destabilizes investment pipelines critical for green energy deployment. Financial institutions experience similar uncertainty. U.S. banks maintain diverse portfolios across Africa, including sovereign bonds, corporate loans, mobile banking partnerships, and infrastructure credit lines. A freeze on new investment introduces the possibility of tighter regulations, temporary capital controls, and reprioritized national development strategies. Banks respond by immediately adjusting risk ratings, tightening lending criteria, and reducing exposure to African markets. These actions send emerging market bond yields upward and trigger outflows from Africa-linked investment funds. The resulting liquidity crunch affects global markets, adding another layer of downward pressure to overall valuations. The geopolitical implications unfold rapidly. With American investment frozen, other global powers accelerate their engagement efforts. China positions itself as the most prepared alternative, offering fast-track credit, infrastructure expansion, and digital partnerships. The Gulf states propose new oil, gas, and renewable energy financing arrangements backed by sovereign wealth funds. The European Union seeks to strengthen ties through green transition projects. India moves to expand pharmaceutical, manufacturing, and digital collaborations. African nations leverage this increased external interest to secure better terms, expand industrialization plans, and push for greater value-added processing within their borders. The freeze becomes a bargaining tool for more equitable economic relationships. Africa's growing leverage stems from concrete structural advantages. The continent controls irreplaceable mineral reserves essential to global technological advancement. Its population is projected to become the world's largest workforce by mid-century. Urbanization is accelerating at unprecedented levels, creating vast new consumer markets and industrial hubs. Renewable energy capacity remains largely untapped, representing one of the world's last major frontiers for clean energy development. Key maritime routes, such as the Suez Canal and strategic West African shipping corridors, influence global trade. The African Continental Free Trade Area provides a framework for continent-wide industrial integration. These structural factors transform Africa from a passive investment destination into a decisive geopolitical force. The freeze exposes the extent of U.S. corporate reliance on African markets. Electric vehicle manufacturers fear constraints on battery mineral supply chains. Semiconductor producers project higher material costs. Aerospace companies face uncertainties in metals essential for engine components and high-temperature alloys. Defense contractors analyze risks tied to mineral scarcity and supply chain fragility. Consumer goods corporations recalculate timelines for Africa-based manufacturing plants. Pharmaceutical companies re-examine research and distribution hubs intended to serve African populations. Each industry faces a different version of the same challenge. Assumptions about Africa's stability as a long-term investment destination can no longer be taken for granted. Macroeconomic consequences intensify. Global markets respond with rapid valuation declines across sectors with exposure to emerging markets, commodities, manufacturing, and technology. Automated trading systems amplify losses as programmed thresholds trigger large-scale sell-offs. Investors seek safer assets such as gold and government bonds, shifting liquidity away from equities and risk-sensitive instruments. Currency markets show volatility as concerns emerge about dollar demand in affected regions. Oil prices experience fluctuations due to uncertainty over future production agreements and geopolitical tensions. These dynamics combine to produce a multi-trillion-dollar contraction in global market capitalization within the first 24 hours of the freeze. Behind the economic turbulence lies a deeper strategic motivation. African nations may seek to renegotiate long-standing economic arrangements that favor foreign corporations over domestic development. They may aim to increase local processing of minerals rather than exporting them in raw form. They may demand improved revenue-sharing models, technology transfer commitments, and stronger requirements for domestic employment. The freeze serves as a mechanism to reset the balance of power between African governments and global investors. It also signals that African nations are capable of coordinated action on matters of continental interest, challenging the assumption that foreign powers can operate without considering unified African perspectives. Long-term implications extend beyond immediate market reactions. The freeze accelerates the global trend toward multipolarity. The United States, long accustomed to a dominant role in international trade and investment, must confront the reality of rising competition in Africa from China, India, Europe, and the Gulf. African governments become more selective about the terms of foreign engagement, favoring partners willing to support industrialization and value creation within the continent. Bilateral negotiation efforts intensify as foreign powers vie for access to markets, minerals, and strategic locations. If the freeze persists, global supply chains undergo structural realignment. Companies diversify mineral sourcing strategies, but alternatives are limited and often more expensive. African value-added processing becomes more prominent as nations invest in refining, manufacturing, and local technology ecosystems. The global green energy transition adapts to new constraints, adjusting timelines and cost structures. International corporations reassess long-term planning, identifying Africa as a region where cooperation must be strategic and mutually beneficial rather than exploitative or one-sided. The scenario concludes with a transformed understanding of Africa's role in global economics. A coordinated freeze on U.S. investment demonstrates that African nations possess the power to influence global markets, shift geopolitical dynamics, and challenge assumptions held by major economic powers. The market shock reveals the vulnerability of global systems to strategic decisions made outside traditional power centers. Africa's rise becomes clearer, defined not by external predictions, but by internal decision-making and collective agency. The freeze marks a symbolic and tangible assertion of economic sovereignty, setting the stage for a new era in international relations. You've been watching Echoes of Africa, where every story carries the sound of tomorrow. If this moved you, subscribe now, like, and share so Africa's voice never fades into silence.